Welcome to AHA Math and Science. In today's video, we're going to talk about some headline news and also discuss if a recession is imminent. So today's headline news is not good. It says Silicon Valley Bank collapses in biggest failure since 2008. This bank, SVB, is the first FDIC insured bank to fail in 2023. And I have a feel that this may not be the last one to fail, this year. And this and actually the closure of Silvergate Bank has caused quite some pressure in the stock market, especially among the bank stocks. And another headline news, which now is kind of shadowed by the SVB news, is the February unemployment rate has gone up. It ticked up from a low value of 3.4% in January to now a value of 3.6% in February. So these two news just give a feeling that there's something bad it might be happening soon. So especially if it could be an indication that the recession is coming. So let's take a look at the unemployment rate chart just for a little bit. You can see here that from 2011, it's going down after the financial crisis, and then it peaked at 14.7% during the pandemic and has been trending downward since. And it reached a lower value of 3.4%, and then it just ticked up to 3.6%. This is the value just released today for February 2023. So does this chart give us any information about whether a recession is imminent, is coming, and how long it may take? So we analyzed a total of 13 recessions since 1940, and we find one common feature. Here's 12 recessions, and the 1945 recession, there's one here that is on this chart here. For every recession, it's just strikingly that it's exactly the same. There's no exception. That is, for every recession, the unemployment rate always first bottoms. Then you have a recession coming up. So there's no exception. So for example, this is the 1990 recession. The unemployment rate bottoms at 5.0%. Then start to tick up, and the recession comes at when the unemployment rate reaches 5.5%. So for every recession, there's a local bottom for the unemployment rate, and then you have the rate starts to tick up, and then you have a recession. Same thing here, same thing here, same thing here, same thing here. So we look at two informations for every recession. One is, what is the lowest unemployment rate, the bottom unemployment rate? For the 1990 recession, that's 5.0%. And the second information we look at is, what is the delay from the unemployment rate bottoms to when the recession shows up? So that is a delay. For the 1990 recession, that's 16 months. But for some of the other recessions, like this one, it almost happens instantaneously. Once the unemployment rate bottoms, then you have a recession followed right away. So for this one, you see that this is 5% unemployment rate. That's the lowest unemployment rate, and the delay is 16 months. So we can actually now put this data point on the chart here. So 5% is the lowest unemployment rate before the recession starts. 16 months is the delay from the lowest unemployment rate to the start recession. In other words, how long does it take for the recession to show up once the unemployment rate bottoms? And the other data points are for the other 12 recessions. So the lowest unemployment rate is quite scattered. So range from below 1% to over 7%. And then the delay from the unemployment rate bottoms to the start recession ranges from 1 month all the way to 16 months with a mean value of 7.8 a month. So this information is what we have. And now for the current cycle, if the lowest unemployment rate is the one that reached in January 2023, which is at 3.4%. And that's going to put us on this vertical line here. So we have 6 recessions around this vertical line with the unemployment rate around 3.4%. These are 3 here, and there are 3 here. So the top 3 has basically a delay of around 1 year, 12 months. In other words, once the unemployment bottoms, the recession will show up roughly 12 months later. And then there are also 3 recessions. It takes less time. It ranges from 2 to 5 months for the recession to show up once the unemployment rate bottoms. So which category we are in the current case? I suspect we might be falling into this category. This is because that in the current situation, you can see that the failure of the regional banks, the major regional banks, is already causing a lot of pressure in the stock market, and especially among the bank stocks. And the financial system, it obviously has a big impact, kind of propagates through the economy. So that is not good. The second one is the layoff in the tech industry since the start has been relentless, and this has not yet fully reflected in the unemployment rate data, and it could be reflected in the coming month. So these 2 pieces of information put together kind of give us an indication that it's not good, that the recession could be coming a lot sooner than people expected, and will be putting us in this category, range from 2 to 5 months once the unemployment rate bottoms. So this certainly won't be good for the economy. But on the bright side, once the recession starts, usually it will not take too long for the bottom of the stock market, for the stock market to bottom. So I hope you have enjoyed this video and found the information in this video interesting. And please do not forget to click the like button and also subscribe to our channel. And thank you for watching.